Thank you, moderator. I think we've had an excellent opening because the most difficult issues have been the first issues that we've been discussing, actually. And if you pause for a moment, all of us, and actually look at the summary sheet of the Prudential Standards, page 45, you'll see that what all the panelists have actually done is just highlight the first few key standards that have been reflected in the document. So I think this just shows that there's something very right that's happening within the community. I think when you look at the context, this came out in 2008, rolled out 2009-10. So this is not like a very old constitution that's never been given attention. This is fairly new as an initiative where the community has come together and tried to follow on the renaissance that the continent has seen in the macroeconomic sector, in the financial sector, in the central bank sector. So if you stand back and you just look at the conversations happening in the room, you see that you have a set of standards that are very bold in putting all the issues across in a way that's never been the case. So I thought I would start, moderator, by talking about the prospects and the excitement in my mind as to the real chance of this community turning around, right? So I think many of us who know the literature of DFIs, it's a very mixed and spotted record, mostly a negative one actually. So now there's real opportunity. Now the question really, in my mind, it's not a question of us not knowing independence or not being aware of the governance issues. I think we're all very aware of that. I think the real issue in my mind is the reforms that need to happen to execute the standards that we are all fully familiar with. How will those reforms happen? That's an issue of political economy, in my mind. It's an issue of shareholder relations. And the ultimate truth is, if you wanted to put a test to this subject, all you would need to do is bring in a pension fund, or a sovereign wealth fund, or an insurance company that has long-term capital, and just ask them a very frank question: would you lend or take up special equity in this kind of entity? And and immediately it would come back to the same discussion that everybody's been having here at the beginning, to look at the credibility of how you're structured. Because you can say all the right things, the form can be there, but if the substance of the checks and balances are not in, the money will not come. That's the bottom line. And I think what's very interesting is, if you were to look at some of the very interesting models of development finance institutions that have succeeded, a lot of it has to do with diversification of shareholding. Because what that does is it introduces discipline into the shareholding structure. The single shareholder model has often been referred to as being a very difficult one to immunize yourself against. Because the ultimate truth is, as much as you may try to fit the form, the standard, the fact that you have an all-powerful single shareholder, and that particular power being exercised in a way that is not always subject to checks and balances, that's the ultimate truth. So in my mind, I think what's very exciting is the way in which this community has become a stakeholder group, an advocacy group. You have the president of the African Development Bank writing the foreword on the standards, introducing the same kind of renaissance that has also transformed the ADB. If you want to be very frank about it, look at the ADB today versus 5 years ago versus 10 years ago. They were not AAA rated. They were probably 1/5 the size then of what they are today. You see the amount of shareholders that are coming into the ADB. So we know what's right. In my mind, it's a question of needing champions and diversity within the shareholder structure to actually help push that reform forward. One of the things that PTA Bank has been doing is we've been actually looking at this list. We have the benefit of being a regional institution, so we have very healthy diversification in our shareholding structure. That helps us a lot. What's been very interesting is, as we've now said to the world, we've turned the corner. For the past 5 years, we've been growing at 20–30% per annum. Profits have been growing at the same level. We had our first credit rating upgrade, and we're saying that we are entirely owned at the moment by sovereigns and multilaterals, but we want to bring more capital into the bank so we can do more, because the gaps are huge. In fact, they're bigger today than they were 10, 15 years ago when poverty was even worse, but there was no growth then, so there was nothing to finance. Today you have a great deal of growth coming in. The demand on development finance is greater than it's ever been. So we've gone to all of our shareholders and we've said, you want us to fill the gaps. You want us to do more. We'd be very happy to do more, but like Mr. Noni, to do more you need capital. Where is the capital going to come from? If you're a very rich country that has a lot of sovereign funding, then you can be less of an intermediary and more of an equity fund. Why am I drawing that distinction? Because if you're a fund that is not leveraged in the marketplace, you can take much more risk. You're a risk capital entity more than an intermediary. If you're an intermediary and you're leveraged many times over, the question of discipline becomes very important. And this is when the central banks obviously would have a specific interest in how a DFI is being handled. So my particular view is if you're a specific type of DFI that is leveraged, that's an intermediary, some of us are actually deposit-taking institutions. If you're a deposit-taking DFI, these features introduce much higher levels of discipline. And so at the end, I think the most exciting thing for me is at least there's a willingness now amongst our leadership, ministers, countries. We've now had an approval to introduce institutional shareholding into PTA Bank. For the first time in our history, we now have pension funds signing up, literally putting in millions of dollars into our capital structure. Insurance companies doing the same thing. We have indications from sovereign wealth funds doing the same thing. There's a reason why they have confidence. They've seen the track record. They've looked at the governance structure. They've looked at the organization issues. And they've looked at how the management structure is appointed. And the bottom line is if you have a competitive and open process of appointing top management, that alone sends a very, very strong signal. When you're just appointed through a political process, that sometimes also doesn't generate the right levels of confidence. The gentleman in the back there talked about succession when you have a change of government. There's this natural tendency to want to change the top management. Well, if the top management, first of all, came in through a political process, through an appointment of that nature, you shouldn't be surprised if the new administration comes in and wants to do that same thing. First of all, the person there doesn't have the credibility of the market. I mean, unless you have a person who's being appointed from a very distinguished background, then it may not be an issue. But in most cases, the view of the marketplace is when you are appointed through that kind of process, the next folks who come around, they want to actually reverse what was done previously. The best way of overcoming that is introduce a merit-based system, advertise, have a panel that's diversified, and allow the best man to win. That is the best way of overcoming the issues you've raised, because any new political leadership that comes in will look at who's there, how they got there. And that actually also deals with the question of succession planning. Because if you raise the bar and you allow that kind of discipline to come into the process, you have a much better chance of attracting new investors, giving confidence to the bond markets, and when there's major changes in big shareholder groups, you get confidence. They come in and they're not going to be very itchy to say, well, this is another government department that's there to do my bidding, and that's how they've been structured in the past in any case. So I think there's a lot of these kinds of aspects to be considered. I think moving beyond the big issues, I would just like to highlight the whole question of learning lessons from the past. Because if we really move beyond the big issues, and you look at what most DFIs had major problems with, it had to do with risk management. And this is not just a question of the shareholder or governance structure. It has to do with skills. Skills, the right policies. How do you deal with credit risk? How do you deal with market risk? We all know that currency exchange rate issues was a major source of problems for most DFIs. They borrowed in dollars and of course could not pay back. It was a classic problem that many of us have studied in schools, but in practice that was a huge problem for many DFIs. And of course the whole credit process. And again, I think here we all have our views on the matter. There's no specific science about how best to manage some of these risks. but I was just looking at the AADFI training program for 2014 that was being put across at the executive committee yesterday. And there was one session that is being rolled out on enterprise-wide risk management. And again, that is as important as governance. It's not just the top-level governance issues. You have governance in terms of risk management. And that really brings into focus the second section of page 45. I kind of see this as a Bible, because the truth is, if you really look at this, it's been done so well. It's been done so well. You look at the second set of issues, they move beyond governance standards, and they start talking about prudential standards in the area of finance and risk, dealing with asset quality, liquidity risk, credit risk. And again, those are the second set of issues. So in my view, I think we need to go beyond just trying to flag the issue or frame the issue, to start building more on the peer review mechanism, and to start saying what's happening on the reforms. And maybe do some kind of a checklist to see, to what extent there's action. For instance, many people have done PGRSs. As we were hearing from AADFI, you may have a situation where the same institution would be brought back 3 years later and said, well, this was your first diagnosis. You fell short in so many ways. Now, you're back 3 years later and there's no change. And so maybe the question then is, perhaps a question to my colleagues in the executive committee, to the House, do we want to maybe create a parallel forum of the principles of DFIs to actually look at what's been done at this forum and to say, well, the institution under your governance, this is how they looked 3 years ago and this is how they look now. And is there any opportunity to accelerate or get more done? For me, it's a question of how does one execute reforms? We have a distinguished governor here who's a distinguished economist. Maybe he has some ideas around how we can get the reforms to actually be done.
Okay, and I think we're going to pull on that resource.
Because President Whitney has dubbed me as an economist, I can start by talking as an economist. The first thing is to understand that for you to build capacity, there has to be an incentive for that capacity. That's what economists say. If there is an incentive, that capacity will be built. But then, how do we create that incentive? That is where we'll start. One of the things, and a recurring thing that is coming up, is that DFIs require resource infusion for them to perform their core mandate. And what we are really also saying is that resource infusion must go hand in hand with capacity to manage those resources and to show results. It is showing results that is going to propel you to the next level. Success always begets success. And that's a very important thing. But pivoted or anchored around that is the governance of those institutions. And I think the emphasis here, when I hear most people talking, is actually operational independence. Operational independence allows that the decision you take should not be questioned if you have followed the rules of the game. If you have followed the processes that the institution is mandated to do, nobody will question those decisions. That's good for operational independence. And I also hear about rating. And I like rating because you can rate institutions in terms of their performance. But we also should emphasize ratings for recipients of those funds from DFIs. And it's a very important aspect because it actually propels or maybe configures everyone from either those who are providing the resources and those who are receiving the resources to play their game appropriately. In fact, this morning I was showing Gabriel Nagato in the Business Daily a report that is there that one lady has gone to court to challenge the information share, the credit rating. Now, what happens if you are the banker? What do you do? Because the moment you do that, then we are going back to the history of there is a moral hazard program, but you don't want that to be opened up as a borrower, but you want to force the bank not to use its adverse selection criteria. How we solve that in Kenya is to introduce credit reference bureaus, and in Africa, and that's why financial inclusion is not going to work unless we have information sharing. Information symmetry, of course. So you can see where we even, if the recipients of funds from DFIs are resisting in terms of their information and their rating, then we have to see we can't succeed. The third point is about regulation. We'll come back to this, but the most important thing is, because it's coming up, is a question of why do we want to regulate? And why do, because we want DFIs to be strong. I'm a very strong believer of strong institutions. And because there are two things that happens when you have a strong institution. One of them is that it defines the appropriate rules of the game. And the second thing is that it defines the appropriate incentives. And the combination of appropriate rules of the game and appropriate incentives will encourage prudent behavior in the market. So you know that institution will be in the market tomorrow. That is the principles we want to emphasize. That's why President of PTA is referring to this book, because it has to be the guiding post of building strong DFIs in Africa. Your question about stock market is interesting. It's one. Actually it's an outcome of what we have discussed so far. Why are stock markets doing very well? One of the things is to look at them as a guy, some 100-meter dash, and you see who is the winner. It's clear during the day, they don't run during the night. You can see objectively who has won with the minimum seconds, isn't it? It's objective as such. But there are 2 points about it. One is that most people who want to invest will go to stock markets because they can invest in slices, or they can slice the project in pieces they can afford. So that you have a flock of people trying to invest in stocks. But the second one is that the management of that company is indirectly rated by the price of the stocks, isn't it? Remember the Tobin Q. We always have taught this in graduate classes. But essentially what you're really looking at, when you look at the price of the stocks of a particular company, you're actually looking indirectly at the management of the company. And that's what we should do. That's why you're saying maybe one route is to encourage DFIs when they have become very strong, list in the stock market, so that everybody will be saying it is ours because they have invested. 2, they will be self-policing. And 3, they will be watching, oh, if the stocks are falling, then there must be something wrong with the management. You see? So essentially, you can see how it becomes a very good reflection. And it's a very good observation that you have shown that it is working. I hear you. We may need reserve currency in Africa, but have we popularized the regional ones that we've come up with? PTA has its own unit of account, but I never hear anybody in PTA mention it. It's only when it is giving its grants it will be saying the PTA unit of account. But we haven't popularized that. What happens is that everybody runs to the dollar, and when there is currency wars like it happened in 2011, everybody now starts blaming local institutions for not looking at it. Now you're saying the dollar is going to weaken. I'm not so sure that is a position. People who will have different positions. It's because we are all hooked, and our analysis is actually geared towards that analysis. But you can see the world is also changing. After the global financial crisis, we have 2 currencies that have been introduced as safe currencies, the Australian dollar and the Canadian dollar, isn't it? So that even those who are managing wealth funds, like in Botswana and other countries like Nigeria, they now have a diversity of doing that. And most of them are even going to the renminbi, that is the yuan. So essentially, we have the independence, the capacity in our institutions to decide which currencies we want to invest in. But as an organization here, we need also to tell each other, please let's share the risks, just like Gabriel said. Our inability to analyze and price risk appropriately is the one that leads us to failure. So if we are capable of sharing that information in terms of what we can do, we can popularize the currency we can use. But for me, being an African and a nationalist, I would say let's look for a currency also that helps us at the regional level. That is our own. And that is, perhaps we'll try to mitigate the risks that we can see and we can understand, because we have peculiar characteristics. If we have peculiar characteristics, let's design our policies and our institutions to address those characteristics to the benefit of our own institutions. Thank you.
I think who will be sitting in this chair, but the governor
said, we wanted to the last minute. Let me also thank the governor for delivering the opening remarks on behalf of the cabinet secretary. I think I'm at a bit of a disadvantage because a lot of what the National Treasury's issues have already been addressed in the opening remarks, and I don't want to repeat, but let me just sort of repackage what has been said in the format of issues, challenges, and prospects. I think the key issues for us at the National Treasury that we are seeing with regard to DFIs is really the weak financial condition of many of the DFIs. The business model, which needs to be carefully thought through and defined in light of what we are seeing in the broader financial sector, including competition and financial innovation, which we are seeing a lot of new products and so on coming from different aspects of the financial sector, which impacts on the issues of DFIs. As my colleague has just mentioned, the issue of corporate governance, political interference is always a concern, and it's something that we need to address. When I looked at, I had the privilege of looking at some of the assessments, the PS, GRS assessments for the Kenyan DFIs, and I see that they tend to score well in operational issues, but perhaps also well in the governance and financial indicators. So those are certainly some of the areas of major concern. So in terms of challenges, this means we have to address the challenge of low access to financial resources. But given the fact that for us in government, we have very limited fiscal space, we have a lot of fiscal priorities, we have social priorities, we have infrastructure, we have a lot of development needs and so on. It becomes very difficult for government to be the source of this financing for DFIs. And hence the need to look at alternative sources of funding. In terms of prospects, as was mentioned by the ADB earlier on, the economies are growing very rapidly, and therefore the financing needs are also growing, and this is really where DFIs need to come in. I think as was also mentioned by the governor in the CSD's opening remarks, we are seeing a lot more macroeconomic stability in the African countries, which puts DFIs in a very good position to be able to contribute towards development. And of course, the issue of natural resources, which was mentioned, a lot of countries are discovering natural resources, and extracting these natural resources requires a lot of long-term financing. DFIs certainly have the competitive advantage in terms of providing this long-term financing, particularly in these areas such as minerals, agriculture, energy, and infrastructure. We are also happy to note that DFIs, with the assistance of AADFI and AADFI and so on, have been able to adopt good core principles, including commercial orientation, sound governance, having a broader range of products, and adhering to the PS-GRS framework. So, for the government of Kenya, what we are doing is putting in place a clear legal and regulatory framework, which has been lacking in Kenya. As was mentioned earlier, we have not had regulation of DFIs as we have in the other African countries. So we need to put in place a prudential regulation structure, and also to address the issues of financing. And towards this, we have developed a draft DFI bill, which we hope we will carry forward through the normal stakeholder consultation process and put in place so that we can have this good legal and regulatory framework for the DFIs. Thank you.
Standing up.
To be watched going forward is the issue of independence and efficiency. In the case of efficiency, even though we say DFIs are not sort of for-profit types of banks, it is not synonymous with being inefficient. You can still be, well, you still make profit, but perhaps not paid out in dividends as your commercial banks would do. But what is important here is that DFIs need to operate under banking codes and standards that apply across the board. They could be not for profit, but they still have to remain efficient because they are, in this case, using public resources, which is even more reason to remain efficient. And then the second is the issue of independence. Independent from government, but not necessarily sort of anti-government. There's no such thing. DFIs are there to implement the government or the national development priorities. So there's no getting around working with government, but again, in the conduct of the business, they must operate under core banking rules and regulations and standards concerning how they apply the loans, the terms of the loans, the conditions, how they treat NPLs and so on, must comply with. It cannot be politically driven. That independence from government in the day-to-day operation of the bank is important, but that's not to say they are sort of at loggerheads. I think these two issues are important and something that we'll continue to monitor. Some of the encouraging trends, PS, GRS, this is an encouraging self-regulatory trend. I think it will save central banks and other regulators the burden of having to come and intervene and regulate if the industry is regulating itself. And some of these improved standards of good governance and so on. These are encouraging trends, and it goes without saying that it's a good business model, it's a good business idea, and something that needs to be encouraged.